What is going on, guys? Nick here, back with another video. The Federal Reserve announced today something that always makes the stock market a little queasy: rate hikes. They announced they would move up the timeline for rate hikes as inflation rises. Because rate hikes tend to impact the stock market, I thought I would make a video explaining a little bit about what's going on here and how this will affect your stocks. So if you remember back to March 2020, when the whole world was turning upside down, the stock market was crashing and the Fed had to make some moves to try to limit the damage to the economy. Businesses were forced to close, causing a chain reaction of other businesses to have to lay off workers, and people were less excited to go out and spend a whole lot of money on goods and services. Well, this is a problem when you consider the flow of money, or how money goes from a customer's hands to a business to the employees, who then turn into a customer, continuing the cycle. When the customers stop showing up, businesses don't have money to pay their expenses, including their own bills and employees. Well, the Fed made a lot of moves to try to get us through, but one of the major moves they made was to reduce interest rates. This made it a little easier for businesses to take on loans to pay their bills and stay alive. But this strategy means the Fed is risking inflation by adding to the amount of money in the economy. So, in general, the Fed wants to try to increase interest rates to balance inflation. But the Fed said that rate hikes won't happen until 2023 or 2024. And if you've been reading some of the news around economic data, inflation fears have started to become more and more common. So why isn't the Fed getting more aggressive and increasing interest rates now? Well, a lot of the inflation we're seeing seems to have to do with competition for supplies and not necessarily increased wages. As the economy starts to normalize the areas where supply and demand has come out of whack, the Fed expects that inflation will subside. But if the inflation increases we're seeing go on long enough, it could raise wages due to the increase in cost of living, which could permanently raise prices for some goods and services in some areas. One of the ways economists measure consumer prices is through what's called the CPI, or Consumer Price Index. In May it jumped 5%, which is the fastest we've seen since the summer of 2008. But these numbers alone don't tell the whole picture. When you go below the top line, there's a few categories that are really driving the prices. The majority of the inflation that we're seeing is related to transportation. More than half of the CPI increase was due to the rising costs of new and used cars, auto rentals, and airline fares. Used vehicle prices jumped 7.3% in May after a 10% increase in April and accounted for a third of the index's jump. Right now, if you haven't heard, there's a massive semiconductor, aka computer chip shortage. These are needed for everyday objects like computers, TVs, thermostats, and cars, especially cars. In cars, everything from the fuel injectors, calibrators, infotainment systems, or even cruise control all require semiconductors. And this shortage has caused a whole lot of car manufacturers to have to close plants because they can't produce cars without the chips. This problem has been made worse by the actions manufacturers have taken as a result. Think back to the beginning of the pandemic when you couldn't find any toilet paper for a solid month or two. When you finally did get lucky, did you buy the normal amount? Of course not. You probably bought 2 or 3 packs since you didn't know when the next time you'd find some would be. Right now it's the same thing for car manufacturers and their chips. They've been buying excessive amounts of semiconductors, which artificially increases demand, and because semiconductor factories can't quickly spring up to meet demand, there's no way to quickly boost the supply. This lack of new inventory has caused an increase in demand in used cars, which of course has really driven up the prices as people get back to regularly driving. Eventually though, the chip shortage will come to an end, with the current expectations around the second quarter of 2022. But as always, we'll see what happens. Either way, I'm not very alarmed by the inflation and the CPI increases so much. And the Fed doesn't seem to either. But when eventually interest rates do come up, what does this mean for stocks? So when interest rates increase, the earnings multiple used to justify stock valuations come down. The reason for this is interest rates act as gravity against stocks. If you had the option to invest in a stock that you think should grow at 10% per year, or a government bond that will pay you 10% per year, you should always pick the government bond. The reason why is there's no risk. Right now, a 10-year treasury bond goes for 1.57% interest. So overall, this is a very low amount compared to the returns the stock market has seen. And usually when the Fed does increase interest rates, it does so at very small amounts, since it will be a huge shock to the system to dramatically increase rates overnight. So I actually have a really handy way for you to see how interest rates will affect your stock valuations. I have a link to my PE calculator below, and I've always included the 10-year treasury bond in my calculation. But before I get to that next, if you could help me out with a quick like and maybe even a comment, it really helps out the channel. I try to respond to all the comments I get, even sometimes the mean ones, and I would really appreciate it. So let's say we have a hypothetical company that we're trying to look at what they're worth. And let's say this company is growing at 10% per year. Right now, with today's interest rate of 1.57% for a 10-year treasury bond, this comes out to a fair PE ratio of 22.5 according to my formula. But now let's flash forward to 2025 and pretend the Fed has increased interest rates. Let's pretend their interest rate hikes have added 1% to the 10-year treasury bond, so now we can get a 2.57% yield for a 10-year treasury bond. Well, this brings our fair PE down to 20.4 for this hypothetical company. But now let's say the Fed goes really nuts and instead they add another 5%, bringing us up to 6.57% for the 10-year treasury bond. This 10% growth per year company is now only worth a fair PE of 14. And just for fun, let's see what would happen if we go really high. Let's see what would happen to our valuation of this 10% growth company if the Fed increased interest rates by 10%. This brings our 10-year treasury bond yield up to 11.57%. which now drops our fair PE value down to 8.5. So a company that grows at 10% per year at today's interest rates, where the 10-year treasury bond is only 1.57%, should be worth a PE, according to the formula that I use, of 22.5. And that same company valued with a 10-year treasury bond 10% higher at 11.57% is now only worth a PE of 8.5. Now let's remember though that this 10% increase is not going to happen anytime soon. If you look at the 10-year treasury bond yield on a chart, we haven't seen numbers that high since the 80s. This chart also puts into perspective of how slow they usually move these bond yields. So let's try to look at things with a more realistic high number. Let's say a worst case scenario is 10 years from now we see 4% for the 10-year treasury bond, something that we haven't seen since the 2008 recession. Our 10% growth company is now worth a fair PE of 17.9, which is about 25% less than today's PE valuation. So these rate hikes should be pretty gradual increases, so I wouldn't get too concerned that your stocks are now going to be worth 25% less than they are today. While you might want to buy stocks at cheaper PE ratios going forward if possible, and also take a little more consideration into a company's debt, the companies that you've already bought shares of should have plenty of time to grow their earnings and increase their share price faster than you'll see earnings multiples decline. Now, if you like this kind of content and you want to see my stock analysis videos, make sure you subscribe and hit the bell notification so you know whenever I upload a new video. And as always, thanks for watching.